Bismillahirrahmanirrahim. In the previous class, if you people remind, we discussed about types of financial statements. Then we discussed about users of financial statements, external users and internal users of financial statements. Then after that we discussed the balance sheet of Basket Wonders, that is a company's name. Basket Wonders balance sheet, this was the asset side. Then after that we discussed about the liability side of Basket Wonders balance sheet. This is the liability side of the Basket Wonders balance sheet. Today we are going to discuss Basket Wonders income statement. Our statement of earnings, and it is in 1000 for the year ending December 31st, 2003. This is the net sales. From this we will deduct the cost of goods sold, the goods which are sold, what was the cost of these goods. In cost accounting you already studied this thing. So this minus this, we got gross profit, and our gross profit, it is 612,000. Then after that we will deduct selling, general and administration expenses. Selling, general and administration expenses. It is 402. When we will deduct this, so we will get 210,000. This minus this, so we will get 210,000. This is called EBIT. It is also called operating income or income from operations. But why we wrote EBIT? Earning before interest and taxes. Still, interest and taxes are not paid. EBIT, earnings before interest and taxes. Then after that we will deduct interest expenses, 59,000. The loans that the company took, company is paying interest on that loan. So it is $59,000. So 210 minus 59, so it becomes $151,000. This is called EBT, earning before taxes. Then from that we will deduct income taxes, 60,000. So we will get earning after taxes, EAT, earning after taxes. Means this money is available to the shareholders. This is the profit which is available to the shareholders. That will be distributed in the shareholder. But companies are not distributing all the money in the shareholders. So they distributed 38,000. That is called cash dividends. That portion of the profit that is distributed in the shareholders, that is called dividend, cash dividend. So 38,000 is distributed in the shareholders. What is left? $59,000. This is called retained earnings. That portion of the company's profit that is retained in the business, that is not distributed in the shareholders, that is retained in the business to expand the operations of the business. So this is increase in retained earnings, that is $53,000. Now, what is a financial ratio? A financial ratio is an index, is a standard. that relates to accounting number, and it is relating to accounting numbers, and it is obtained by dividing one number by the other. What is basically a financial ratio? It consists of two accounting number, it relates to accounting number. And how it is obtained? And is obtained by dividing one number by the other. Now look at this. The first, if you will take an example, so the first ratio, it is current ratio. I am writing short. It is basically current assets divided by current liabilities. Now current asset, it is an accounting number, and current liabilities, it is also an accounting number. So how financial ratio is obtained? This is a financial ratio. Current ratio is basically a financial ratio. How it is obtained? By dividing one accounting number by the other accounting number. This is an accounting number, current assets of the company. This is another accounting number, current liabilities of the company. So when we divide one accounting number by the other, so we will get a financial ratio. And it is just basically, this financial ratio is relating to accounting number, this accounting number and this accounting number. Now look at this, the previous balance sheet. What is our current assets? 1195. And what are the current liabilities? 500. So 1195 divided by 500. So we will get something, I think it is 2.36. So we will get 2.36, which is a financial ratio. This financial ratio gives information to the company. Information about what? So later on we will discuss about this, which type of information this ratio provides. Similarly, other ratios, these are also obtained by dividing one number by another number. So what is financial ratio? It is an index which relates to accounting number. It shows the relationship of two accounting number. And how it is obtained? When we divide one accounting number by the other accounting number. Current asset is one accounting number, and current liability, it is another accounting number. So we divide one accounting number by the other accounting number. So we got this value 2.36. Now this 2.36 has a meaning. What is the meaning? Later on when we will start ratios, so we will discuss it. Now types of comparisons. There are two types of comparisons. One is called internal comparison and the other is called external comparison. One is internal and one is external. Now what does it mean? Internal comparison means, suppose this is our company, Basket Wonders. This is year 2019, 2018, and 2017. What was the profit of the basket founders in 2019? It was, suppose, 100,000. In 2018, it was 90,000. And in 2017, suppose it was 120,000. So now what are we doing? We are comparing our today's performance with our past performances. The profit in 2017, it was 120,000. Then in 2018, profit becomes 90,000. It comes down. But again in 2019, there is an increase of 10,000 in the profit. So this type of comparison in which we are comparing our today's performance with our past performance, that is called internal comparison. That is, when we compare our today's performance with the past performance of the company, the same company. Now, there is another type of comparison that is called external comparison. So what is the profit of basket founders? In 2019, it was 100,000. There is another company. Suppose the name of that company is ABC. What was our profit in 2019? 100,000. In 2019, the profit of ABC, it was 150,000. So our profit is less than this company. In 2018, their profit was 100,000. And in 2017, their profit was only 90,000. So see, we are comparing our performance with other companies. When you compare the performance of your company with other companies, this type of comparison is called external comparison. Or you are comparing your company's performance with the whole industry. So comparing your performance with your past performance, your today's performance with your past performance, that is called this one. This is called internal comparison. And this one, comparing your performance with other companies, this is called external comparison. So these are basically two types of comparisons. But keep in mind one thing, that this involves comparing the ratio of one firm with those of similar firms or with industry averages. This is basically external comparison. Similarity is important, as one should compare apples to apples. This means that you will compare your performance with those companies who are doing the same business. Suppose if you are comparing the performance of Salam University with a cement company, so this is not fair. You will compare the university performance with other universities, and you will compare a cement company performance with other cement companies, and you will compare the performance of a textile mill with other textile mills. So here comparing apples to apples This is basically the meaning of this thing, that you will compare your business with similar businesses. Then there are different types of ratios. The first type of ratio, we call it liquidity ratio. This one. What is basically liquidity? Liquidity means that the firm can pay its short-term liabilities on time or not. The ability of a firm to pay its short-term liabilities. This is basically liquidity. Are converting your assets to cash. But here we are not considering that thing. Liquidity means the firm's short-term debt-paying ability. That can the firm pay its short-term liabilities or not. So it is basically a balance sheet ratio, this liquidity ratio, because both the items that we are picking, it is from the balance sheet. We are not taking any item from the income statement. So that's why it is called a balance sheet ratio. The name of the first ratio in liquidity, it is called current ratio. And what is the formula? Current ratio is equal to current assets divided by current liabilities. We already discussed this thing. Shows a firm's ability to cover its current liabilities with its current assets. It is showing the ability of a firm that can the firm pay its current liabilities with its current assets or not. Like if you will take the example here, this one. Okay, I will write it again. Current ratio, shortly I am writing, is equal to current assets divided by current liabilities. So current assets, it is balance sheet item. Current liabilities, it is also a balance sheet item. So current assets are 1195 and current liabilities, it is also, I think it was 500. I show you the balance sheet. Now we got a number from this, 2.39. Now what does it mean? 2.39. It means it is basically a ratio. See, below it is current liability. If your current liabilities are $1, you have $2.39 to pay this $1 liability. Mean if your liability is $1, you have $2.39 to repay your this $1 liability. So this 2.39, there is a meaning of this 2.39. It means that you have 2.39 times money to pay your current liabilities. If your liability is $1, you have $2.39 to repay that liability. So here the firm's short-term debt-paying ability, it is very good. If it is 1.5, it is good. It shows a good current ratio. Means the firm can easily pay its short-term liabilities. 2.39, compare it with 1.5. So it is showing a good ratio. Now check it here, 2.39. Now the main thing, comparison. Year 2003, 2002, 2001. This is basket wonders. In 2003 their current ratio is 2.39. We calculated. In 2002 it was 2.26 and 2001 it was 1.91. They took this data from the past, so we don't have any information about this. Just the figure is available. So don't confuse yourself in these numbers. Okay, now this is basically the internal comparison. See, basket wonder in 2003, what is the ratio? 2.39. In 2002, 2.26. In 2001, 1.91. So this is today's performance, and these are the past performances. So comparing your today with your past, so this is basically internal comparison. Now external comparison, comparing your performance with the industry, the whole industry average. So see, 2.39, 2.15. So we are above the industry average. And here in internal comparison, our performance is becoming better and better. 1.9, 2.2 and 2.3. In 2002, 2.26, 2.09, the industry comparison with industry. In 2002, our current ratio it was 2.26 and the industry it was 2.09. In 2001, 1.91 and 2.01. So now look at this, ratio is stronger than the industry average, means the basket wonders ratio it is stronger than the industry average. See, it is 2.39 and it is 2.15. So our ratio it is stronger than the industry average. So for today it is enough. Inshallah, in the next class we will discuss about the second ratio, that is quick ratio.